Okay, so today is Thursday, November the 3rd. It is 7 p.m. over in London. That makes it 3 p.m. on the east coast of the U.S. where I am right now. And okay, let's see, what does it say? Jimmy, we've had lots of audio dropout in both previous sessions. Can we get downloads of your presentations from earlier? I'm not sure, Alan. That depends on the office, really. I send these recordings out to everybody I have on my list. Anybody who's a current student, I do send the copies out too. I've sent both sessions 1 with the PowerPoints and session 2 with the PowerPoints. If you're not yet a student, then it's up to Win Investing. So you'd have to talk to them about it. Fair enough. Okay, so let's get started here. Again, the reason I'm doing these sessions is because I've had a lot of people come to my seminar in London saying they'd love to join our more advanced program, but they don't feel they're ready. They don't know enough about trading in general. So what I tried to do was, Alan, I see you writing here. You're gone again, but I think what you're going to find is if there was a problem, I would see that from a bunch of people, and you're the only one. So it has something to do with your internet, my friend. It doesn't have anything to do with my side, as far as I can tell. Everybody else seems to be okay. Otherwise, they would be safe. Yeah, audio sounds fine. You know, a couple of people coming in saying it's just fine. So, Alan, I don't want to drive you crazy. It has something to do with your end. Okay, so let's get rolling here. I did want to welcome John Martin. He's a new Pro Trader student as of this morning, actually, as of today. So welcome aboard, John. Okay, so let's get started. Again, I started to say the purpose of this is to give the people who need some more background on trading a head start. This is not meant to be a teach you how to trade Forex session as much as to give you some background on how to trade the technicals. So let me start by sharing my desktop with you, monitor 1. And slideshow from the current. Okay, there we go. Okay, so what is technical analysis? Technical analysis is predicting where price is going based upon where price has been and what price is doing right now. That essentially is what technical analysis attempts to do. Just about everything related to technical analysis has to do with looking at charts, looking at price action in one form or another, and basing your decisions on trades based upon what you see from the price movements. It ignores all the fundamentals, all of the reasons why it's happening, and it focuses strictly on the price action itself. And there's quite a bit of it. We've had a computer revolution, as you know, internet revolution. There's thousands and thousands of what's called technical indicators, things that are speeding up the price, slowing down the price, doing all kinds of things, looking at just the price itself and trying to predict where it's going based upon the price itself. It leaves out the whole idea of why things are moving, which is the subject of our next session, fundamental analysis, what I like to call the F word. So let's look at some of the more popular ones and some of the things that you'll probably have read about or seen something about, and you're probably curious what it's all about. Now, the basic place we need to start is where price has been, and then the concept of a prevailing trend. So when you look at a chart or you look at anything else, prices tend to either be going up, or they tend to be going down, or they tend to be going sideways. And so if you look at a chart, your prevailing trend is a function of the amount of information you have on that chart. We talked about in our last session how to prepare charts. So if I'm looking at this 5-minute chart, based upon the information on this chart, we have an uptrend. Now, if there was information before this, which of course there was, we would look at that information and maybe we'd make a different determination. But from looking at the information on this chart right here, what we have is an uptrend. That is the dominant trend, and it's very clear to see. Over here on a daily chart, we have a downtrend. It's clearly in the down direction. So this would be called a downtrend. That is the prevailing trend, or the bigger trend on the chart. Now over here, you also have an uptrend, and not much else cooking there, you can see, just a straight uptrend. And on the weekly chart over here, we have what we call a sideways trend, because we've kind of hit bottom, hit top, almost hit top again. We're somewhere in the middle. So we call this a sideways trend, because from the information on this chart right in front of us here, it can't be determined whether it's going up or down. So we consider it to be going sideways. So at any time you look at a chart, you can look and say this is an uptrend, a downtrend, or a sideways trend. Those are the three possibilities, and what we're looking at is the more dominant, and that would be this. This is something else, but the dominant is up, therefore this is an uptrend. The dominating influence is still down, so that's a downtrend. This is an uptrend. And this here we can't really tell because it's bent both ways and it's in the middle, so this is called a sideways trend. So the very first thing we need to think about when we look at any chart is, what is the prevailing trend? And it's a judgment call based upon the information that you have on the chart. If you have more information, it may change whether you think it's an uptrend or a downtrend. So you decide how much information you think is relevant, and then you decide. Usually that's something to do with the last move of any significance. From looking at any chart, you can see what the last move of any significance was. In this case, we would say it was the uptrend, to move of significance. Now, in terms of time frame does matter. So we'll talk about this a little more in a moment. A daily chart is a much longer period of time, whereas a 5-minute is a lot shorter. And the amount of risk and everything else involved would vary according to the time frame you're looking at. Now, what is price doing right now is the second thing to consider, but it's always thought of in terms of the prevailing trend. Now, if what it's doing right now, if it's trending, it means it's moving in the direction of the prevailing trend. If it's counter-trending, it would mean it's moving in the opposite direction of the prevailing trend. If it's going sideways, there's just no clear apparent movement, so there's not much we can really say about it, except that when it's going sideways, it could be bouncing off what we call support, or the lower part of the chart, prices, or bouncing off of resistance, the higher prices. Let's see what this looks like. So here you're looking at a 5-minute chart, so you're looking at day trading from minutes to hours, and you have a move up. So your prevailing trend is up. Now you have a move down. Now, if the prevailing trend is up and you have a move down going on, that's called a counter trend. So it's counter trending. It's not moving right now in the direction of the trend. This move down is called a counter trend. Now, over here on the 1-hour chart, what we have on the 1-hour chart is we have an uptrend, and it's more or less staying pretty close to the highs here. And therefore, it's not trending higher at the moment. It's just consolidating at these higher prices. So we call this consolidating. Over here, on the daily chart, we have a clear downtrend, and the latest move is an up move. So what we have is a counter trend. We have a downtrend going on, and what's happening right now is we have a movement in the opposite direction as the prevailing trend, and this is called a counter trend. Now down here, because we have a sideways deal going on, when we get near the top or get near the bottom, depending on what it's doing. So here, it came down to the bottom, or what we call support, and we'll talk more about what support is. We're bouncing off of that support and going back up. So that you use the term bouncing off support. If it was up here and it was turning down, if that was the latest move, it would be bouncing off resistance. But the important thing to remember, there's two things going on. The prevailing trend, which simply means when you're looking at this chart, what is the dominant direction? In this case, it's up. What's happening right now? It's going down. So your prevailing trend is up, and you have a counter trend or a shorter term downtrend going on. So you're in an uptrend, but now you're in a counter trend. Here you're in an uptrend, you're just consolidating. Here you're in a downtrend, but at the moment you're in a counter trend, you're moving up. And in the sideways pattern down here, you're bouncing off of support. So far, what have we done so far? We've identified prevailing trend. That means when you look at the chart and you choose the number of periods you're going to look at, and if you don't know what number of periods means, you need to go back to session 2, which was charts. We did a week ago Monday, and I covered that in detail. So a prevailing trend is whatever that is, then what's it doing right now? And we're relating what's it's doing right now to the prevailing trend. If the prevailing trend is up and the price is making new highs right now, then it's trending with the prevailing trend. If the prevailing trend is up and right now it's coming down, well, then it's counter trending. Okay, not too hot. Hopefully so far so good. Now what we're after, the reason that technicians look at this at all is they're interested in what's price most likely to do next. Now, it can only do one of two things. It can continue to do what it's been doing most recently. In other words, what's going on now, it can continue to do that, or it can do something different. Those are the two possibilities. Now, the way we try to determine what's it going to do next, whether it's going to continue to do what it's doing most recently or do something different, there's chart analysis, which is we're looking at the charts, and there's also momentum analysis, which is digging a little deeper into what the charts are saying. Today I'd like to cover trending, what exactly ways that's measured, counter trending, and how we would be looking for the trends against the trend. That's what counter trending means, to end and go back into trend. These couple of tools here, these two I actually teach in my programs. I like these very much. I also teach about moving averages and 3-bar reversals. These are things I teach in my own programs, and I like to cover them. And then in a sideways market, there's support and resistance, there's breakouts and false breakouts. So this is, in chart analysis, these are the main things. There are lots of others, but I want to give you guys as much as I can in this short session. So I'm going to cover all of these one at a time with you. I'm also going to cover, time permitting, some price momentum analysis, things like MACD and RSI, stochastics, Bollinger Bands. These are all things that, as new Forex traders, you're going to hear these things. You're going to hear, oh, I used the MACD. Oh, my stochastics did that. Oh, the Bollinger Bands are doing that. So to have at least a little feel, not a complete education, teach you exactly how to use these with every possible exception, but just to very briefly show you or tell you what these things are and how traders use them. Some of these have been around from the 1950s, 60s, 70s, 80s. they've been around for a long, long, long time. All of them started off being used for stocks, and we have some people in the Forex business who try to use these now for Forex. So we're going to at least look at them because they, as a retail trader, you're going to kind of feel you're missing something if you don't have any knowledge of these, because you do hear about them quite a bit. And we'll just take a quick look at them, time permitting. So let's start with moving averages. You know, moving averages is a very basic indication of trend. So let's talk about what a 50-period simple moving average is. To calculate a 50-period simple moving average, we would take the closing price of the last 50 periods, add them up, add up all 50 of them. Then we're going to divide the total by 50. So let's say you have 50 periods, and you're going to take the closing price of each period. Now a period, remember, a period could be, each period could be 5 minutes, each period could be 1 hour, each period could be 1 day. But we're going to take the closing prices of the last 50 of them, add it all up, and then divide by 50. Now, if this was 1965, that would be a tough task. That would be a big adding machine project. In this day and age, with Excel and the speed of computers, it takes about 1 second, if it doesn't even take that long to do it. Now, when you add them all up and divide by 50, the answer is the average for the last 50 periods, and it's a number. Now, where does the moving of the moving average come in? What that means is that we're going to take the last 50, so when the next period occurs, so let's say we're looking at a daily, we took the last 50 days, we divided by 50, and then another day passed. So now we're gonna add that new day in, and we're going to eliminate the other 50. So we're going to, okay, so all right, so that's where the 51st comes in. Now, how traders use moving averages. You can see that hold on 1 minute, please. Okay, sorry about that. All right, so the first candle completely below the moving average indicates a bearish trend. So you can see here's the moving average line. So let's say over here, for example, it's taking these 50, adding them up, dividing by 50, and it's saying that's what the price would be. And it takes the 51st one, 51st, and it eliminates the one that's 51 back and takes the latest 50, and it says, okay, now it's here. And it keeps plotting that. Now, a very simple way to use a moving average in terms of trend is to say when it's below the moving average. So over here, it's in a down move. So potentially sell is something you could consider doing. And then once it goes above, it would be a buy. You can see it holds up pretty well. Now when you use moving averages, what we tend to do is not simply buy and sell when it just goes above or below it. We tend to give it a little extra space, a little more above or more below. And so that's how that would work. Now, in terms of trend, you can see that the trend looks down. Now the prevailing trend is up. You see how the prevailing trend is clearly up. And now this here would be a counter trend. So the trend is clearly up. This is the counter trend. If you look at this chart, the trend is down. Once you get above here, that prevailing trend would be up. So all the down moves are considered counter trend. And you can see how the price tends to do that. It tends to keep going back towards in little loops like that. That's very, very typical. In fact, some traders even consider time. This is time along the bottom. and it's all symmetrical. So you can see maybe this is, we're looking here at an hourly chart. So every couple of days it seems to make a, a little loop. That's very typical of the way things move. But this is your moving average, and this is a very basic measurement of trend, and it just, this line here kind of indicates where your trend is. So you start to be in a downtrend, you go into an uptrend. This is sideways so far as the moving average line goes. But in terms of the price action, this would be now considered clearly an uptrend. So this would be a counter trend down going on. All right, so let's move on. We'll move on to trend lines. That's another thing. Traders love their trend lines. So when you have this move down, initially you need at least 2 points to get started. So from here to here, that's from there to there, you could draw your line. Now you can see how this line's going out into outer space here. It's moving away from the price action. So what traders do is they redraw their trend lines, and as the trend develops, they look for what looks like a more accurate line. This line kind of fell out of style. It looks like it's coming back into play, but whether it's relevant or not, what you're using it for at the beginning here is perhaps that the third loop comes over here, and that would be potentially a buy area. The fact that it didn't, then it starts doing this. This is when you start moving your line, drawing your line further. But clearly, different ways we're trying to look at the uptrend. Now, one thing you can do is you can take this line, and as your trend is developing, you can try to guess what the top part would be. So hence, you're trying to guess where the loops are. And then as it starts moving really far away from this, you can tell it's changing. It's losing its upward trajectory. And this is just basic, very basic technical analysis. All right, let's move on to Fibonacci retracements. You see, if this is an uptrend, if the trend is up, it's an uptrend, and you're counter trending. Another word for counter trending is retracing. And if it was to get all the way down here and get below the beginning of your uptrend, then it would be called a reversal. But it's not a reversal until it would get all the way down here. So we call this a counter trend or a retracement. Over here we have a downtrend going, so this is an upward. This is an upward retracement. This is a bullish trend, so it's a bearish retracement. And the idea of retracements is basically, if we still believe that the trend is up, then we're looking for some kind of a bargain price to buy it for the next move up. And here, if we still believe the trend is down, we're looking for a good place to sell it for a resumption of the trend down. See here, we got an uptrend going, and we're making new highs, so we're not in a retracement. Here, this would be a retracement, but it's very, very tiny, as you can see. So it doesn't really present what we would consider would be a good bargain or a good level to be adding to a position from the uptrend from a retracement point of view. So we want to talk about retracements a bit because it's something that I think is very important. So I'm going to go through this with you step by step. We got a downtrend going on here. Again, this is all the same chart we're looking at. Euro dollar daily chart. So we got a downtrend going on, and this here, this is a retracement in a downtrend. So we have a downtrend going on, and it's starting to retrace. Now, depending upon your view, you may be looking for a place that you want to sell because you believe at some point it's going to turn around and keep going down. Or maybe you bought it and you want to make sure that you sell it before it turns around and goes back down. As a trader, you could look at it either way. But traditionally, when you have a downtrend and this is a retracement of that downtrend, most traders think about it in terms of finding a place to sell, because they assume that this is going to, at some point, keep going down. And so the trend will reassert itself at some point when this counter trend is over. Now, the popular way of looking for levels where this may stop and go back down is called the Fibonacci series of retracements. Fibonacci's lived in the 12th century, and he's a pretty famous guy. He actually came up with the idea of the zero. Before that, there was no zero. And so he's a pretty famous dude. And he came up with this series of numbers called the Fibonacci numbers. And traders use the Fibonacci series of retracement levels, retracement numbers, when they trade. So we want to go through what they are. And the most popular is the 38.2, 50, 61.8. These are the three most popular Fibonacci retracements. I only teach my students about the 78.6. This is the only one that we're interested in for our trading. Although these other ones, again, they all have, for different traders, they use different ways. And many traders use them quite well. Just for me, I just use this one here. We use this every day in our trading systems as part of our strategy. But let's go through them here and step by step. So just to show you how one is calculated so it doesn't seem so numbery. You know, I can feel for you sitting there. I can feel your pain. You're seeing a big red arrow, a little green arrow, and all kinds of percentages and numbers, and what does it all mean? Going a little Botox on me, your heads are starting to wrinkle and your eyes are starting to squint. What the hell is this? So I'm going to go through one with you, and again, it's not really that difficult. What you're going to find is most of the indicators and most of the stuff that these technical people use, technical traders use, and what's on all these softwares out there that some of us have spent thousands of dollars on, is nothing more than just a manipulation of numbers, which is not that difficult. So let me show you, for example, the Fibonacci retracement of 50%. Like, how do you determine that the Fibonacci retracement of this down move, where this 50% price is, this 138.47? And I can see I got a little error there. There should be 138.47. I'll fix that later. Okay, so we're starting with the highest price, which is up here. Let me see if I got my pen going here and highlighter. So that's the high price. Okay, that's this. And down here is the lowest price, and that's this. So if we take the highest and subtract the lowest, it tells you how big the actual move was. So the whole move from the top to the bottom was 1,406 points. Now, what we're after here is we want to know what a 50% retracement of this 1,406 point move would be. Well, we start with what is half of 1,406. That would be 703. 50% of 1,406 is 703. So starting from the lowest price, the 131.44, the bottom here, if we were to add 703, that should tell us, it should be 138. I got that number a little wrong. That should be a 3. 138.47 is where the 50% retracement is. Let me do that again. Some of us are new to this, so if you're not new to this, you find this too easy, I apologize, but this is a basic presentation. From the highest point to the lowest point, 145.50 to 131.44 is 1,406 points. We want to know if it retraces half, or if it goes back up by half the distance it came down, where would that number be? Well, if it came down 1,406, then half of that would be 703. So from the lowest point down here, 130.144, if it went up 703, it would be 138.47. Hence, that would be a 50% retracement of it went down 1,400. If it goes back up 700, that's how the computer figures out that price for you. That would be a 50% retracement. The 38.2% retracement would simply be saying you would take 1,406 points times 38.2%, which would be like 500 and something points, and you would add the 500 and something to the lowest point, and that would be retracing 38.2. And so these calculations are actually pretty simple. You see the term Fibonacci series of retracements. It sounds very complicated, but it's actually a very simple thing. You're just simply saying it came down quite a bit. If it goes up a certain percentage of what it came down, where would that price be? Because we may want to try to sell at these various prices, thinking that the move has run its course. All right, let's move on to our next slide here. So now you can see here the price goes up to the 38.2 retracement level. Now, a lot of traders try to sell at that level because their thinking is this is just a little bit of a correction to the downtrend. It's corrected enough, it'll continue to go down. Personally, I don't look at 38.2. The next one would be the 50% retracement. This I kind of peek at. I don't really trade it, but I like to be aware of it because it does coincidentally, a lot of times it retraces half before it continues down. So I want to at least be aware of it. And I usually just be aware of it by looking at the chart and seeing that this is about half the distance of that. I don't necessarily go in and put it on a chart with a number. Don't nearly think it's necessary. Now, it got to the 50% retracement. Now, let's see what happens. Now, you can see when it got to the 50% retracement, it did come back down. It started to come back down a little bit. So a lot of people would try to sell as it starts to come in down because they figure, okay, that's it. It's going to go down here somewhere. Now, as you can see, it starts to stay around the same levels. Now, this is something we're going to talk about in a little bit. You see, this is the highs, and this is the lows. So this becomes like a trading range. And depending on which way it clearly breaks out of it, either that way or that way, that will tend to tell you what the next move will be. We're going to go over breakouts, support and resistance. This is support. That's resistance. That would be a breakout to the upside or a breakout to the downside. And we're going to talk about that more in a little bit. Now you can see we broke away to the upside here. So that would be bullish. It would look like it's going to at least head to the 61.8 now. This is how traders would look at it because it's kind of breaking away towards the upside. Certainly the 50% didn't hold is the expression you'll hear traders use. It didn't hold the 50%. It's going beyond that. It's retracing more than that. And then it starts to do a sideways deal, nothing special cooking. Then we get a big jump up like this. Now, in this case, we went exactly to 78.6. By the way, this is last week. This is a daily chart of the euro-dollar pair, and this is last Thursday. So last Thursday we made this huge move up to our 78.6. This happens to be the level that I teach, the one that we trade every day in our programs. We like the 78.6, and So what I told the traders is I think from here, because we made such a huge move up, that it's probably going to have to come down for a while. And that gives us an idea of how to trade it. You know, we look at the chart here and we go, gee, this is the biggest bar on this whole chart. As far as the eye can see, going back to August, we haven't seen anything this big. So this looks like it's overdone. Now, I would also consider the fundamentals and the reason why it happened and the reason it did this in the first place and the reason it did this as part of the strategy. You know, when I teach people to trade Forex, I teach them both the technicals and the F word and the fundamentals. And people kick and scream until they see how powerful it is to understand what they're doing. And I convince them that when you're spending your own money trading, it's a good idea to know what you're doing and not be too bent on just having something that's simple and easy for your own money. It'd be better to truly understand what it is you're doing from the point of view of what you're actually seeing and what's causing that and putting it together. Most people at first don't want to go in that direction. Most of them never do. Most of them blow out a couple of accounts and give up because they're just looking at charts and they're only looking at half the story. But that's something we'll talk more about next week when we talk about fundamentals, next Monday. That would be November 7th. Same time. Now, this is what happened over the next 3 days. We had a huge drop down, and we were totally anticipating this was going to happen because we were thinking that this was totally overdone. First of all, from a charting basis, but also for the reasons of why it came up in the first place, etc. There was just a lot of arguments that this was getting ready to happen. And the Fibonacci retracements certainly helped us, but it was only a small part of the final of the analysis. But it certainly helped. And from a technical point of view, it was perfect. I'll give that to the technicals. All right, now let's move on to something we call candlestick patterns. The beauty of the candlestick patterns is they fit like a glove with the retracements. So essentially what a candlestick pattern does, it identifies when something is likely to turn around and go the other way. So let's say you have an up move, and then you have a trend, and then you have a counter trend, and it comes near the 78 fib, and then we get the right candle pattern in here indicating it wants to go up. The fib's telling us this is probably the bottom, it wants to go back up. We got lots of things telling us it wants to go up. So we go from just playing a straight 78 fib retracement to having a 78 fib retracement and also a candle pattern telling us it's a good time to jump into this trade. Let me show you what this looks like. This is one example. This is called a hammer. And the idea is this is where the price opened and this is where it closed. At one point during the period, and we went over this last time with the charts. If you don't know, you have to go back to the charts to see this stuff. But at one point it was all the way down here, but at the end of the period it had gone all the way back up. If we've seen a downtrend and then we see something like this, it usually means it wants to go that way. So I guess you could understand if we had a Fibonacci retracement level over here saying we think it could go back up, then we see something like this. We got a lot of things telling us it wants to go up, and hence we're probably making a good decision to buy it. Here's just some drawings of it. These is 6 different currency pairs at different times, and this is how it would look. You see you're coming down, and you see in the pattern you're coming down. Now, if these happen to be agree with your Fibonacci levels, etc., they would make them more powerful. These are things that, on a very rudimentary level, traders look for to find their trades. And then it's good stuff. It's good stuff. But again, you know, what you want to think about is if you're going to really put up real money and trade for real, do you want to go in half-baked or know a little bit about this and a little bit about that? or do you really want to know what you're doing? That's what you want to think about. All right, I'm going to move on to support and resistance. And support and resistance is very important. We spend a lot of time, and we have a number of systems that are related to support and resistance. We find it to be really important. So let me just give you a little basis of what it is. Support means a place on the chart where there is likely to be some buying, and that buying may possibly stop the price from going any lower than that particular support area. So it's an area where there were some low prices made before, and now we're back there again. And it's possible that once again it could be an area where the buyers will come in, and it'll cause the price to stop going down and turn around and start heading up again. Resistance means a place on the chart where there's likely to be some selling. So the price goes up, and at some point in the past it's been at that price, and it stopped at that price last time, and now it's back at that price. And theoretically, that there's some selling. That's where people are going to want to sell if they need to sell. And it's very possible, if there are sellers there, that that'll stop the upward price action, and the price won't go any higher than this resistance area, and then it'll tend to come back down again. So support and resistance, identifying them on the charts, is very important as part of the technical analyst trading strategy, is to be aware of where the support and resistance lie. This is a chart I prepare for my students. It's in my high-low charts package. It's the very last tab to the right. And it's a chart of the euro-dollar pair. And this is called a point and figure chart. We went over this last week as part of the charting. But I'm using it here to show you an example of a support area. So here was an area. This is the lowest it got, so it's a support area. The price was coming down. It stopped here. It went back up. Now, the next time it comes down in this area, right over here, it touched it again before it went back up. So support held is the expression we would use. Up here, we have the resistance area, because that's where it stopped this time around. After this support area, this is where it stopped. And so when we look forward, we expect to find resistance as we approach. So once we've done this much, the next time we come down, we expect this support area to hold. So if you look at this, this is about that 78% retracement would come in right about here, right, pretty much where it stopped. This would also be support. Now, when it went down, it held this support area. When it went back up, if you look measure from here to here, also about 78%. It stopped here and made another move down. Now, if you tried to buy it once again using this, you would have gone through here, but not your original support. You would have held that original support. And then in between, you can see from here to here, right up here would be 78, but this became a new resistance level a little lower. And so on until it breaks out. Now, this becomes a trading range, because it was this wide, it's getting a little thinner and still a little thinner. So it's getting thinner and thinner. You see, so it's a trading range. Now, when you have a trading range, eventually you have to leave that range, and that's called a breakout. So when price is moving back and forth between support and resistance, it's called range trading. When price goes above the resistance or below the support, it's called a breakout of the range. When a breakout occurs, you expect to see further price action in the direction of the breakout. So let's take a look what this means. So here's your support and resistance. This is a breakout here because it's going above the resistance area. Now you're probably wondering, well, what about back here? Well, this is out of the game now. This isn't considered part of it anymore. We're now focusing on this latest resistance area. So according to that, okay, that's a breakout. And it's not unusual to come back into the resistance area a little bit and start to break out again. But once it initially breaks out, we're expecting it to go higher. Now, there's such thing as a false breakout. False breakouts occur quite a bit, and a lot of times they actually are traders. Many traders make the mistake of well, they don't really know what they're doing, so they tend to put their stop losses very close by, and they tend to jump out of their trades way too soon. When a false breakout occurs, that means that we were anticipating further price action in the direction of the breakout, but it didn't occur that way, so it would be called a false breakout. Now, see, some traders would look at this and they say this is a false breakout. Now, I don't think that's correct. I think something more like down here. If it gets through the middle of your support to resistance area, up until it gets to the middle, I can still consider it possibly a breakout. Once it gets beyond the middle, then perhaps it is a false breakout, and we're probably going that way. Once it gets below the lows here, it's even more confirmed. But when you're looking at false breakouts, most of the time traders are looking at something like right here, and they're trying to get a jump on a downtrend, and all they do is box themselves in. This goes a little lower, then goes up again. And then they blame it on their spread betting platform, or they blame it on the banks in Cohese to beat them up, and everybody's doing something to them. But what they don't realize is they just don't know what they're doing. That's the issue. All right, now, before I move on, I'm going to move on here to look at some of the price momentum analysis. Now, I have to warn you that this is much more difficult than what we just looked at. And I cannot explain to you and teach you how to trade MACD, RSI, stochastic, Bollinger Bands. First of all, I don't use any of these in my own trading. So to me, these are okay, but it's not even any of these I use. They're all good. They're all good for what they are. And they're all from the 1960s, 70s, 80s, and they all were developed for stocks, and somehow they've been kind of square peg and a round hole pushed to Forex, and very half-heartedly in many cases. But these are things that have to do with looking at the momentum. And again, I'm not going to give you a full course on these. I'm just trying to show you a little bit about them. If you want to, you can go to Wikipedia, Investopedia, Chartopedia, all the pedias, and you can get all the information, and you can play around with these for weeks or months if you'd like to. I'm just going to give you a little feel for what they are, because you are going to hear these terms. And the first one, MACD, every new retail trader gets hooked on MACD. The reason I think they like MACD so much is they have no idea of what it's doing, but what they do know is that it's very easy to identify where the trade signal is supposed to be. So what's involved, and it's probably a good thing, because half of you are probably sitting there going, yeah, I trade the MACD. Do you know what it is? No, I don't have a clue. Well, here's a clue. There's three things involved. You have what's called the MACD line. Now, we did not talk about we talked about a simple moving average was, a simple one, where we just take, in this case, if we were looking at a 12-period simple moving average, we'd be looking at the last 12 periods, the close of the last 12 periods, whether it was hours or days, whatever it was we were looking at, whatever chart, divide by 12. Now, exponential moving average means they place more weight on the most recent activity and less weight on the further back. So in this case, when you're looking at a 12 period, say the first 12 periods back is going to have this much weight, and 1 period back may have that much weight. So they weight out the 12 periods, and they say ones are more important than the others. So they create like an index, so to speak. Bottom line is, it's just a moving average that places more emphasis on the most recent activity and less emphasis on the stuff further back. So with the MACD, they take two of them. They take the 12-period exponential moving average, and they take the 26-period exponential moving average. And what they do is they say, well, what is the actual, it looks something like this. They say, what is the actual 12-period exponential moving average? Let's say that price is 141.50. And they say, what's the 26 period? And that's 141.20. Now, what the MACD line is the difference between the two. In this case, if the 12 is at 150 and the 26 is at 120, then the 12 is above the 26 by 30 points. If you look at the difference, it's 30 points. So the MACD line plots a plus 30 because the 12 is above the 26, so it's showing as a plus 30. If it was the other way around, and this was the 26 was at 50 and the 12 was at 20, then it would plot it as minus 30. So that's what the MACD line is. It's simply the difference between these two moving averages, plus or minus, and it's always considered good, a plus, if the 12 is above the 26. And if the 12 is below the 26, it's considered bad or minus. That's the first line. That's called the MACD line. Then what they do is they take the last, the MACD line is just a number, right? They take the last 9 of them, and not the moving average of the last 9, but the exponential moving average of the last 9 MACD line calculations. They come up with what they call a signal line. Now here's the thing. Nobody understands this, and nobody ever bothers to even try to explain it. They just tell you how to trade it. And I think it's important to have a feel for what it is, to think about whether or not this is something you'd actually want to trade or why you'd want to trade it, other than it's easy to trade and you'd be fashionable to say you trade MACD. Now the histogram is looking at, you're taking your MACD line, you're taking your signal line, and there are 2 lines. And the histogram is simply looking at the distance between these 2 lines. So this is what it looks like on a chart. And I realize this is not so easy for you, but then again, you look at this diagram of what I just explained to you, this don't look so easy either. All right? So what you got is you got your 26-period exponential moving average, that's this line. You got your 12-period, that's this line, right? Now your MACD line is taking the 12 minus the 26. So when the 12 is higher, well, let's see, the 12 is lower here. So when the 12 is higher, so over here, when the 12 is higher, then this line is going to be above the 0 line. And when it's below, it's going to be below. So over here, up to here where it's lower, it's going to be on this side. Now, the signal line is taking the last 9 of this MACD line, the difference between these two, the last 9 computations of that, exponential is creating this line. So this is kind of, the signal line is kind of a slower line than this one is, because it's taking the average of the last 9 of these bad guys. So now, why do traders like it so much? Because they don't have to have any clue except that when this thing changes direction, that's when they should do a trade. That's why they like it so much. That's all they got to know. They can just look at the histogram and say, okay, it's time to buy, it's time to sell. Now, you look at this and it looks great, and it looks like, wow, it's telling you exactly what to do all the time. The only problem is that when you look at it close enough, you'll realize that by the time it gives the signal, a lot of times, where the time the signal is clear, you're buying it up here and you're selling it down here by the time you actually get the signals. You know, over here, for example, you're getting your signal, but it's already way up here. And that's why the MACD looks very good on paper, but when you go to do it, it may not be as easy. This chart here is a MACD as of an hour ago. I made this about an hour ago, and this is a daily chart of the euro-dollar pair. And again, it looks great when it looks like it's calling these turns, like over here. You know, this looks great. This looks great because she just moved down. But then you got to realize that, okay, you're going to be selling it over here somewhere, which is good, but you're not going to be buying it until over here. So although it looks good on paper, it may not be so good. Now, over here, you're just going straight up the whole time. And this is saying to do all kinds of stuff. You know, it's going back and forth above and below zero many, many times. And it's just a straight up trend. Now, this is excellent over here, of course. You do good. But again, you're not getting out until you're over here. So overall, it's not as pretty as it looks. Now, that's just a quickie for MACD. There's a lot to MACD. You can read about it, and you could, there's plenty of different interpretations of it. There's lots of different ways that traders use the MACD. I'm just trying to show you very briefly that it's not quite as much as it may be sold to be, if you will. Now, another one that's very popular is called the Relative Strength Index, the RSI. Now, the RSI is pretty simply, it's an index. It's got a big calculation that I don't even understand. But basically, it's saying when all's said and done, it creates two lines, one line on a chart, and if that line gets above 70, it's overbought. If it gets under 30, it's oversold, and anything in between is neutral. So this is how it looks essentially. So this is your RSI line. So it's saying over here, this is a daily chart, it's probably overdone, and we did get a little correction there. That's pretty good. It says up here it's overdone, and it did go down. That's good. And then on the bottom side, it doesn't tell you much except over here, it's saying it's overdone. There was a little bit of a bounce, very similar to this. And then once again, it tells you it's overdone. It should go back up. And this time it went up very nicely. So on a daily chart, the RSI looked pretty good, at least for this period of euro. And the beauty of it is all of this, when nothing's going on, it tells you to do nothing, which is a good thing. It's basically telling you nothing's overdone. It's just kind of not doing anything special, which is kind of a good thing. Now, there's more you can read into it. There's such things as divergence and all. I'm not going to go to that level. We're not really ready for that yet. But this is the 70, and that's the 30. Those are the two levels. And this is a very popular one. It looks nice on a daily chart, no question. Now, when you look at it on a 1 hour chart, it can get a little bit dicey. So here, for example, it's telling you it's overdone, and that's over here. We still had all this to go, so that could have got a little expensive. And the same here, it's telling you over here it's overdone, and that's way up here, and that could have got very expensive. So on a shorter time frame or on a sudden move like that, the RSA can be tough. But there's filters and different ways to trade it and all. I'm just trying to give you an idea of the pros and cons of some of these what's called momentum. These are called momentum indicators. And again, I'm just giving you a broad brush feel. We have an RSI expert in the house, and he's got some opinions other than mine, I understand. Just trying to give you a feel for what I see based on just a rudimentary look at these. Just remember, we're not trying to teach you to trade the RSI. We're just showing you briefly what it is. Now, stochastics oscillator, this again is, I believe, from the 1950s. So again, to me, this one here, I find this is what they look like. This is called fast stochastics. This is called slow stochastics. For me, it just doesn't really do much for me. As it gets up here somewhere, it's supposed to go back down. If it gets down here somewhere, it's supposed to go back up. It's just too much of it for me. It doesn't look. It just doesn't look right to me. It's just. I've traded stochastics in the past, and I found by the time you actually get the crossovers and the signals, when you're looking at it on the chart, it don't look too bad. But when you're actually doing it in real time, the actual levels you're dealing at are not nearly as attractive as the way it looks here. So by the time this is giving a sell, for example, it could be that the move is almost over. Although if over here it looks good, when you actually zero in on it, it's not nearly as attractive. And when you hit these kind of things and it just keeps telling you it's overdone, that's pretty nasty. Although these are nice when it's giving you the overdones as it's coming down, that's okay. So it has its good points, but again, I don't know how many of those you could live through. But that's just a very brief look at it. And again, they use the numbers. Some use 80-20. These are your numbers here. Some use 80-20, some use 75-25. Depends on, you could use 90-10. Everybody has different ones. But what you're looking for is both lines to go up past whatever you're using. And then when they turn around and they both go back through the level, they cross each other, then they go back through the level. Theoretically, that's your entry point. I've never had much luck with it myself. This is looking at it on an hourly basis. And again, you can check it out more yourself in detail. The other thing is when this doesn't look like the price action, when this, see over here, you see how this looks exactly like the price action? Well, when it's not looking like the price action, that's called divergence. That's also something people like to trade. Again, it's just a little too theoretical for me. The last one I wanted to cover briefly is Bollinger Bands. Bollinger Bands, essentially what they do is, as you can see, it seems to be able to encompass the price action no matter where the price action goes. And the way it does, it looks at the volatility from over here and assumes that that volatility will be over here, and it widens the bands and narrows the bands according to how the volatility is. And the way people trade it is, some people, when it hits here, they're buying, or it hits here, they're selling. And again, the problem you run into is, well, what about here, 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 here? The point is, when it really goes, it's not as cute as it looks. Although some people like it. Again, some people do well with it, and some people, they buy it when it hits the bands. And I'm not a big fan of it. It's not something I really trade. But this is what it's supposed to do. It's supposed to look at the volatility and tell you when it's overdone. And personally, the way I like to trade is not to be worried about overdone, except from the point of view of taking profits when it's probably overdone. But entering trades because it's overdone, which the retail client loves, is not something I like doing. I don't like trading that way. Here it is on an hourly. That was on a daily. Looks pretty much like the same thing. And again, these are all buy levels. Apparently, I don't know. It's kind of strange. But people do it different ways. If it goes outside of it, they expect it to go back in. You can look it up. It's something you can look at if you think it's worth trading. a lot of people do use it. There's no question about that. We've got a few minutes left, so we got about 10 minutes left. So let me show you a little bit about some of the things that I use myself personally. And again, it's beyond the scope of today's presentation to do anything more than just show you very briefly what I actually do, but just to give you a taste of it. Just pop some charts up here. So for example, pound dollar, since most of you are in Britain, and this looks like today. Yeah, this is the 3rd. This is a 5-minute chart for today. So this is what we do. We want to know, when we look at today, we start today at 5 p.m. Eastern time. We consider that the beginning of the day. And at 5 p.m., when it comes around, which is in about another hour, we consider that to be the end of the day. And I don't know if that's going to let me put that line there. Probably not. It wouldn't let me put a line there because it hasn't happened yet. These things are very temperamental. Now that one's stuck there. It won't move. All right, there's no problem. Well, I could just do this. Instrument, pound dollar. Here's my 5-minute chart back. Lines, add lines, freehand. So from here, I say this is the beginning of the day. And then we look at the beginning of your day, which we consider 7 o'clock in the morning. This is in GMT time. This is in London time. We consider that the beginning of the day. And what we like to look at is what's been the lowest and highest during this period. We look at that line, add lines. We say what's been the highest and the lowest during your time period. And then we have our own little studies. We just have our own little thing we look at in terms of giving us buy and sell signals. So this would tell us buy in here, buy in here. This would be a sell over here. Comes down. So this is how some of the things that we would look at. We would also look at how high we think this could have gone today, and we would look at this, and based on where the price is over here, we would predict what we think the high for today would be. So we would go to here. And you're looking at stochastics and RSIs and everything else to come up with the highs and lows. We would look at this, and we think the highest today, 160.61, we think it could have gone to today. And the high today was 160.62. So we missed it by 1 point. And that's just based on using our own mathematical formula to come up with how high we think this could go today. So right there. We'd also predict how low we could think it could go as an extreme. But see, we're using that level right there. From the beginning of the day, we're saying that if it gets up here, that's about as far as it's going to go up today. So what we're looking to do is find places to buy it, but we want to be out of it when it gets up there. Because we're looking at it one day at a time. That's about as far as we think it could go. And we would use that number. We call it room to go number. And we find that very helpful as opposed to looking at stochastics. So if we put stochastics on this, edit, delete all objects and studies, the same chart, we would have studies, and we could go down to stochastics. That would be stochastics as a slow one. So it would tell us today, and today started right here, it would tell us all of this information. And what I don't like about this really is this whole thing here, it doesn't really, I don't see any difference between this when it's doing nothing and this when it's doing a big move. I don't know. I don't really see it. Again, I'm not bad mouthing. I just don't understand it. So another one there is fast stochastics, I don't think it's going to look any different. You know, again, it kind of tells you it's overdone. For the whole move, it tells you it's overdone. Eventually, it's going to get it right, but it's just not something that I would use. Get rid of all of that. And studies, we can go with MACD. All of these are canned indicators, so you can, here's your exponential moving average. See, so you would use, if you wanted to do MACD, you put 12. And studies, and you use 26. Change the color to something else so you can distinguish. Okay. So that would be the 12 and the 26, and then you go studies, MACD, moving average, convergence, divergence, and then these are called defaults, and there would be your MACD, if you will. And you can see, you know, it looks, again, it looks like it's pretty good until you actually go in and you try to use this thing, and then you got a lot more going on than you can imagine. You know, it's good for your spread better because it'll have you in and out of the market every few minutes doing something. Studies, another one would be RSI. So let's edit, delete all objects and studies. Studies. Now this is all, every platform will give you all this for free. Is the RSI. And again, you know, it's basically through the whole move, it's just telling you you shouldn't be in it, it's overdone. You know, again, I'm not bad-mouthing, I'm just saying that for me, it's not really what I'm looking for to trade the market with. The other thing I use to trade the market is this. It's called Forex Climate. I'll pop that in there and show you this. And again, none of these things are perfect, but this is my own software my students use. And just got to make it a little smaller because it doesn't fit in the window. So let's see. Shift. There. Now you can see the whole thing. And say the euro-dollar pair. Well, let's see pound-dollar pair. You know, it gives you indications of what to do along the way in different time periods. In the 4-hour time frame, for example, it wrote it up all the way up. This is since the middle of October, stayed long until the end of October. Now it's trading it short. And euro-dollar, that's 1 hour. So this is 1 day, 2 days, 3 days, 5 days. Wrote it down, switched, went back to short. Now it's writing it back up. 4-hour time frame. It was long since the beginning of October, and now it's trying the short side of it. You know, this is what I use. You know, this is what my students use, our own software, and we use this as our way of looking at overbought, oversold. Okay, so that's today's lesson. I hope you guys have enjoyed this. Again, it's not meant to be a complete analysis of all the things we looked at, just to give you some ideas of some of the technicals out there that others use, a very brief idea of some of the things that we use. It wasn't meant to teach you anything we use specifically, just to give you an idea, a rough idea of what's out there, a rough idea of what we use, and hopefully that will be a little helpful for you. So let me turn it over for a couple of questions. I'm gonna cut the tape here to keep it nice and short, but I will. You can type in any questions you have now, and I'm happy to answer them for you. But first, I need to close this off. So let me end this. Let me stop the recording.